What a crazy end to the year. Welcome to the stock market update. Whilst everything looks expensive with the exception of energy and banks, this is price to forward earnings. It just teaches you that valuation is not the only metric, because the things in red are the ones which have performed the best this year as well, even though they're the most expensive. So the money sometimes is to be made by looking beyond valuation alone, as we do. We look at value, growth, income, cash flow, all of these factors across 10,000 stocks. Now, getting into how the week has gone by, as you can see, pretty much everything green, and a lot of green. So you look at Broadcom, which is up here, that was up 20% in a week. So the semiconductor is doing incredibly well, and we'll touch upon some of those in a second. But right across the board, you could barely pick a stock and not be right this week. What about exchange traded funds? I've done a video on this on my YouTube. So even if you're not a part of my Great Investments program, have a look at my YouTube channel, and I've done videos on the exchange traded funds, and I've selected a few of those to see if any of them look interesting. Remember, you're only really going to get into funds if you want lower volatility. And if you want lower volatility, you're going to expect lower returns. This is not a good year for going for low returns. The Nasdaq's up nearly 52%, 1% for every week of the year. And the S&P is up 23%. So I've got a bunch of people on the Great Investments program who are up nearly 100% on their pensions because they were very Nasdaq heavy from the start of the year. I've got others who are a bit older, a bit more cautious. They're more S&P. So they're up between 25 to 50% on the depending on the picks and how they did things and when they joined the program. That is pretty phenomenal for your pension. Of the top 10 S&P stocks over the past month, you can see them over there. Doesn't necessarily mean we'd be getting into any of those or that we find any of them attractive, unless they are on the approved filtered list, because they don't have to just tick momentum, which is all that does. They've also got to tick valuation, growth, income. Otherwise, you'd just be getting into things which have already risen and are about to fall. You can see Rolls-Royce, which is quite popular, up there at 25%, doesn't make our approved filtered list. S&P 500, where are we on that? Well, we are skyrocketing away. And most importantly of all, when I look at the momentum indicator and the monthly, and I use it a way the textbooks don't, you can see it's still continuing to rise. Now, what I love about this is there is always some people who, of course, don't know much about the markets or analysis, and they'll say, oh, isn't that a lagging indicator? You should look at the future, such as the crystal ball indicator and the sunspots indicator. Honestly, the number of buffoons who have no idea what they're talking about on social media, it is incredible. Anyway, just to follow on from my 200 Financial Times columns and my 18 books on investing and my career as a hedge fund manager, that's the direction I think it's going to go. Okay, but for those of you who want to educate me about Fibonacci, you know, that historic numerical phenomenon which you think is so forward-looking, good luck with that. Now, positive, that's what it is, that's the bottom line. Whereas for the FTSE, well, what generally tends to happen is when this indicator hits its own moving average, it tends to bounce a bit lower. So be aware, as you can see here, you get a bit of a pause. So you might get this rise, but you'll get a bit of a pause to try and freak you out. So be ready for some of that. Anyway, the FTSE is at 2018 levels. So fantastic. Great. Well done. For basically 6 years, you've had no return if you're British. But that's the way you like it. You like low growth and poverty in your pension. Whereas, of course, being British, as I am, I like growth. And if I look at this, well, the index alone is up 100%. And you better believe my cherry-picked pension is up a lot more than that in the last 6 years. So let's have a look at Apple. We'll call this the Apple strategy. Okay, now we've looked at the fundamentals on this: valuation, growth, dividend yields, cash flow, Sortino, alpha. And you've got three choices ever to make with any company: buy, hold, or sell. I already own some of it, so I'm at the hold. If you put a gun to my head, I would today buy if you buy more, if you put a gun to my head. Now, this indicator, which is just one measure, of course, we've looked at fundamentals. You know, we take note of what the analysts are saying, but don't really care, or seasonality. More importantly is this rising, neutral, or falling, which is negative? And at the moment, it's sort of around here. Now, that doesn't bother me too much, because if we look at previously what's happened with that kind of a pattern, it can slow down for a bit, as it did here, before rising and doing its thing later. And I suspect, as things stand, that's the most probable format. In other words, some rises, but not skyrocketing away. So that's the Apple strategy. Put a gun to my head, I would actually buy more. Okay, that's what the analysts think. That's their returns. That's the average analyst forecast. And if the market does that, that's where you end up. As for Alphabet, and by the way, before I get into Alphabet, don't forget, have a look at alpeshpatel.com/links if you would like a free review of your portfolio by a hedge fund manager. If you don't worry about it. It saves me time. Now, that is a little bit negative, that the weekly MACD, a measure of momentum, is falling, but this is going sideways. Now, in the past, that has happened before. You've noticed it here. It's happened here as well. And it's not really been too detrimental. We're just hoping it's not one of these where it's a steeper fall. There's no reason to think it will be. So I'm not too worried at the moment on Alphabet, and I continue holding my Alphabet. Okay. As for Microsoft, it is slowing down a little bit. That could be on the turn. This will definitely fall. Okay. And that's where we are with that. So again, more of a hold, but if you did put a gun to my head, I probably would buy. As for you Fibonacci lovers and Elliott wavers, the mental asylums the other way. Okay, now Amazon, right? This is where we are with this. That's the direction I'd likely see it going. Don't forget, yes, there's a whole load of analysts and their views on it. There's seasonality. We've looked at valuation, revenue growth, and so on. So I remain positive on it whilst we continue to hold it. If you put a gun, you know what I'd do. I'd buy some more on this one. Right, Disney was a special situation. It wasn't on the approved filtered list, but it's a special situation. That's the direction we're looking at. And I've put a pretty optimistic note there. You can see that the banks, JP Morgan, think it's a buy. So does all the others, Bank of America, and so on. That's where we are with that. The Nvidia strategy is basically, if this falls X1, you will sell Y1. All right, if it falls X2, you will sell Y2. Y2 will depend upon your risk appetite. Simple as that. That's what you do with it. Now, why would you be that precautious? Well, because it could do this. And you don't want to say to yourself, oh, I'll just hold this for 50 years, because it could have long periods where it does that, where you basically lose 2 years of potential returns, because you would have missed out on this one, because you're recouping the falls there. That's not time in the market. You want lots of time in the market, all that kind of cliche rubbish you hear on social media. We're not trading our investments. Time in the market can cost you 2 years of lost living, because that capital could have been used doing something useful, and this gain could have been unencumbered by the preceding losses. So this whole notion of, just stick with it forever, would imply you're living in the 1960s and regurgitating cliches from the 1970s. So that's the reason why we may well get out if it drops 10% or 20%. We don't need to do that often, so we're not trading the investment. And our biggest concern is it could do that as it did here. And we're trying to avoid that situation. And the reason is we like money. That's why. We don't like being a loser. That's why. Okay? So that's where we are with that. The analysts think 34% to the upside from down there to up there. As for Tesla, well, we did get out of it from here. It was a special situation from the start of the year, which was on my Telegram channel. So you can have a look there. Don't forget the Telegram channel is alpeshpatel.com/links. You'll find it on there. We got out, and since when it's gone higher than our exit price. Does that mean we were wrong? No, because we got out because I was happy to get out, take the profits and reduce some of the equity exposure I had. But I keep showing this because it's a bellwether and people are interested in it, and it probably will do something like that. So if you wanted to get back in, entirely up to you. I might review it again as a reinvestment. But for the moment, happy that I'm out. It's fine. I've got enough exposure to other things. Meta is very much like Nvidia, so just be careful it doesn't do this again. And again, this is why the lie about, it's the time in the market that matters. I mean, the ignoramuses who follow that, well, I should thank them because it's their money that I guess we get a bit of when we're doing derivatives trades. But this is where Meta is. Now, all of that gain, all very good. But you didn't want to lose it all and then some, did you? And just waste 5 years of your life, did you? And that's why we do these broadcasts on Wednesdays and Fridays. And occasionally, as in February of last year, where we had to say in 2022 February, I think it's time to sell. And the only reason we said it is because of this. That's why, you know, so much for, oh, it's backward looking. Okay, that is why. We saw that and then it got worse. So you could argue we're a bit late. We should have sold 2 months earlier. But anyway, we sold in February of last year, 2022, to get back in January of this year. You can see Telegram. So you might say we got in a bit too late. We got in a bit too late. We should have got in there. It doesn't matter. We got in here, and that's been a good 200% return this year. As for what's going to happen, we'll keep an eye on it, but at the moment it remains a hold. Okay, and my pension's doing fine with that, thank you. Now, ServiceNow, for ages, I was getting a bit frustrated. If you watch my broadcasts on YouTube and so on, well, actually, it's been sideways for bloody months. What, since April till about a month ago? It was sideways, and I was thinking, when's this going to go? And now, all of a sudden, it has. So there's patience for you, and it's paid off. But we'll keep an eye on it, just in case it has a steep fall. But the banks all love it, don't they? Okay, so that's ServiceNow. Now remember, if you are on my, I'll do Cisco in a second, Great Investments Program, you'll get a detailed version of this on the private Telegram channel. And if you're not, well, this is where Cisco is. So after it fell off a bit, we said, well, hold on, see what happens. And indeed, it looks like it's going to go in the right direction after all. But like I said, we'll keep an eye on it. That should go up there. It should hopefully turn up. So that's where that is. Now, Netflix I don't own, but I cover because, well, it's popular with you little kids. And that's where it is at the moment. That's the projection we put in from since we covered it. And that's what we think will happen. Obviously, JP Morgan, Wedbush, Morgan Stanley, all the rest of them seem to like it as well. There's your seasonality. December doesn't tend to be that great for it, but blooming out, January and February in particular do. So I'm expecting this to continue up there as well. And there's your Netflix. Thank you. Do have a look at the campaign for $1 million, ton of free resources. If you're this year thinking, why is your fund manager, your IFA, whether you're in America or the UK or anywhere else in the world, not generated a 50% return, which is what the market's generated with the NASDAQ, or even a 20% return, which is what the S&P 500 has done, then it's usually because they've sprayed and prayed a load of funds, which the best excuses I've seen so far from people who've asked their fund managers, why have we done so poorly, is, oh, well, we're not put you in the US markets. They're a bit expensive. Great, well done. So they like keeping you poor then, don't they? Anyway, good luck with everything, and do get in touch. And if you'd like a free review of your portfolio, alpeshpatel.com/links. Thank you.